Alright, I was only going to do one video today, but this seemed like a good video to do at the very first day of the year. Reviewing everything so far. Number 1, trading hierarchy. 2, types of pairs. 3, pips, lots, leverage, and risk. 4, your tools. 5, choosing a broker. 6, trading styles and analysis types. 7, a funded trader. 8, technical analysis. 9, making orders. 10, Fibonacci basics. 1, trading hierarchy. Remember that you need 3 parts nailed down to be a successful trader: risk management, trading psychology, and trading strategy. If you can track something, you can improve it. So I hope you've been keeping notes and keeping track of your data. 2, types of pairs: major pairs, cross pairs, and exotic pairs. When you trade matters too. If you're trading the USD as your base currency, your spreads will increase after 5 p.m. Eastern Time. There's also more active times than other times. On most of these slides, I've put the lesson that talks more about the subject in red on the bottom right. So if you want to learn more about this, it was video 3 of class 1. 3, pips, lots, leverage, and risk. Pips are the percentage in point and are used to calculate the rates trades in the Forex markets. The rates traders in the Forex market will pay. A lot is 100,000 units of any currency and is the unit of measurement you will use when making your orders on the Forex market. Leverage enables traders to borrow capital in order to gain a larger exposure to the Forex market with a comparatively small deposit. Risk management is the evaluation of financial risk together with the identification of procedures to avoid or minimize their impact. You can stick around long enough to be a winner and let your edge play out like a casino. Four, your tools. By failing to prepare, you are preparing to fail. Get yourself set up with tools you're comfortable with: screens, computers, phone, platforms, data providers, software. I have multiple computers ready with all my tools already set up, and I have a backup phone too in my safe just in case. Some things we talked about were setting up MT4, Webull, TradingView, Forex Factory, and my FX book. Five, choosing your broker. There's many things to consider when choosing a broker. I suggest starting out with a demo account first and worrying about this later. I don't know if I've mentioned this before, but I double your account with consistency on a demo account before touching real money. By consistency, I mean don't make 3 huge trades and get lucky. For a trader, lucky is just a distraction. Why? Because it's impossible to be consistently lucky. 80% of NFL traders go broke. 70% of people that win the lotto or get super lucky other ways go broke. All of these people don't understand the importance of consistency in regard to bringing money in with money. Obviously, or they wouldn't be broke. The more capital you have, the less risk it takes to make more money. If you have $100 million and lose it, you're truly an idiot in regard to risk management. 6, trading styles and analysis types. We've learned there's scalpers, day traders, swing traders, position traders / investors. The degree of difficulty lessens as you go down the list. There's 3 analysis types: fundamental, which is news, data releases, details of a business's books in the past, and projections. And there's technical, which is chart patterns, and there's sentiment, which is how others feel. Please remember, wash sells if you're going to trade securities. 7, funded trader. We talked about the pros and cons of trading someone else's money and your own money. This is for you to determine. I'm a fan of doing both. My method is building my personal trading account and then taking some of it and investing money in something less volatile and more consistent, like real estate. I've talked about why I started these courses, but another reason is I'm looking forward to another income stream. If you live and die by a funded account, I think that's completely stupid. You can lose your account, anyone can. We're playing with probabilities, not certainty. No matter how good you are at technical analysis and risk management, you're still relying on probability. Also, stress kills your body and it'll also kill your trading. You need to be in a place of seeing opportunity and being able to assess risk without fear. I have multiple income sources: teaching, construction, trading, and investing. I want more sources. It's more sustainable and less risky. Hopefully you have something other than trading. It comforts me to be able to say I can always pay my bills by working my butt off because I know I trade. Don't keep all your eggs in one basket. Make your finances as sustainable as possible. Kind of a rant. 8. Technical analysis. We talked about five items in this lesson. 1. Trend, uptrend, sideways, ranging, or consolidation, downtrend. 2. Support and resistance. Support is where people are buying. Resistance is where people are selling. 3. Price patterns. These are patterns that traders have identified as signals for a potential future direction. There's triangles, flags, head and shoulders, double tops and bottoms, and the cup and handle. 4. Candles. We talked about a lot of different candles, and it's something else you can use to stack the odds in your favor on a trade, or use them as entry and exit points or a signal to get in or out of a trade. 5. Indicators. We talked about the moving average, RSI, volume, MACD, and Bollinger Bands. These are more tools to put in your bag to validate or invalidate a trade. Remember, I love to stack confirmations, and so should you if you're trading. 9. Making orders. We talked about 6 different orders you can make. You can buy or sell a market, limit, or stop order. You'll set up a stop order if you think if price breaks through, it'll keep going and you can ride the momentum. Limit order is when you think price will come back and bounce off. And market order is when you make an order at the current price thinking it will go a certain way from where you've bought or sold. 10. We talked about Fibonacci. It's the golden ratio many traders use for determining where price will pull back to and bounce off, or where price will extend to, called Fibonacci retracements and extensions. And remember, these are just numbers where you want to watch the price do what you want it to do for a second confirmation. Just because price has come to the 68% retracement doesn't mean you just buy there or sell. If you missed anything or anything was unfamiliar, I invite you to go back to it and watch it again. If you're still confused, it might be a good idea to use the free resources on YouTube I mentioned, or pay for them if they really vibe with you. I have watched videos of people on YouTube that are confusing and or don't know what they're talking about, so I can only recommend Rainer Teo, The Trading Channel, and The Secret Mindset. I also enjoy watching The Blockchain Backer for his TA, and he also has a teaching course which I have not paid for yet, but I intend to. Also, I enjoy TXMC. You can find him on Twitter. That's it. Stay symbiotic. Give me a like. Give me a hit the subscribe button. Send me a comment about one of my videos that may have been confusing. I should probably go back into the future and cover more details about Fibonacci. I'm not sure if one of those lessons is going to be coming in the near future. But yeah, let me know if you're getting value out of this, and if not, tell me how I can give you value, and if I can't, go somewhere else. Thanks. Bye.